Hello and welcome to another episode of Macro Mondays. We're actually filming this on Friday afternoon. We have a bank holiday in the UK on Monday. We filmed this 3 hours after the US economic payroll data's come out. Anyway, my name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
This week we'll look at the economic data that's come out. Key economic data, well, the market's got low expectations because of the tariff news, but actually the economic data is coming out actually beating expectations. And what we've also seen this week is crowded tariff trades such as long gold and long euro dollar are now being unwound.
Yeah, we'll examine some of the headline risk that we're seeing driving things at the moment. We'll look at the underlying nature of the US economy in particular, as there are fears that shelves are going to start running bare. And we'll also discuss the OPEC news that they've decided to bring forward their meeting to discuss increased output.
Firstly, to the US payroll data that's just come out, the key piece of economic data of the week. The market had low expectations. All the other employment data we've seen this week has been weak. JOLTS, job openings, ADP, initial jobless claims, continuing claims, and the employment component of ISM all being weak, and payrolls beat expectations. Estimated to create 138,000 jobs, 177 were created, and the unemployment rate has remained at 4.2. So a bit of good news to finish the week.
Yeah, it's definitely, the headline is all supported, and 4.2% is not a particularly high unemployment rate, as we've said many a time. So yeah, there's a cause for optimism as we're sort of going into the new month of May. And it's, particularly interesting looking at 1 month ago was obviously the Independence Day in the US. So I think, we can obviously discuss how things are compared between now and then, but it's a slightly better situation, at least in the headlines that we're seeing today.
Yeah, I tend to think this is a bit of a lull before the storm. As I said, the subcomponents or data early in the week's come out weaker than expected. But also, if you look here at the chart, this is both temporary and permanent job losses coming from the payroll data. They're both ticking up now. That's trending. And we're going to definitely get job losses from the resulting impacts of the tariffs. So I think this is a bit of a lull before the storm really kicks in the next few weeks.
Yeah.
If we move on to ISM manufacturing data, Institute of Supply Chain Managers, again, a diffusion index, above 50s expansion, below 50s contraction. Market was expecting this to come in really weak. There were calls for it even to be as low as 44 due to the regional Fed surveys like Philly Fed, Dallas Fed and Empire Fed. Came in better than expected at 48.7. So still in contraction, but better than expected. And again, equities rallied on this.
Yeah, I do see these expectations, though, as being a bit of the side story, and the fact that they are in contraction, this is undeniably a bad metric. So even if you do see an equity bounce based on the exceeding of expectations, these expectations are low. These expectations are still contractionary. And so even though it's beating them, it's a sign of a wheezing, coughing, spluttering economy.
Absolutely. As we say, the impact of the tariffs is yet to be hit. And if we look at the subcomponents at ISM, new orders was 47.2, employment was 46.5. That's why the market was so bearish going to payrolls. And prices paid, well, that was the only one in expansion at 69.8. So this is the worst case scenario for the Fed.
Yeah.
The chart here is dollar yen. Again, I highlighted this last week. You can see how technical analysts would call that a perfect head and shoulders pattern. You can see there's a key support at 140, and we've had a bit of relief basically because the data isn't worse than expected. The pressure's not, or the data, I was going to say the pressure's not on the Fed to cut rates. It certainly is from Bessent and Trump, but the economic data is not pressing on the Fed to cut. We have a meeting next week. Market's not expecting anything. And the market's pretty close to 50-50 for whether they cut in June. On to consumer confidence. We highlighted last week how Michigan consumer confidence was the lowest, weakest for 50 years. The main US consumer confidence came out this week. That's saying it's the lowest since May 2020. And you can see from the chart here, you can see expectations fell to the lowest level since 2011 as well. So consumer confidence is down. That will hit retail spending.
Yeah, the momentum is all one way here, and the echo chamber that people hear surrounding tariffs, etc., combined with poor manufacturing data, it's all understandable that consumer confidence is low and getting lower over time. I don't think this is a particular surprise.
Yeah, what I find it's clearly trending, and what I find is economists, I think they're too upbeat with their expectations, and similarly the Fed, you can see the market, it's incrementally pricing in more cuts. Though OAS, I'm surprised we don't get it more rapidly.
Yeah.
Within the consumer confidence, you can see inflation expectations have surged as well. Consumers expecting inflation above 6%. Again, worst case scenario, it's stagflation.
Yeah, and comparing the consumer confidence we said before was lowest since May 2020. Obviously, there was a huge amount of uncertainty with the COVID pandemic around that time, and people simply didn't know what their personal incomes were going to be like, what the shape of the economy was going to be like at that time. At the moment, I think people do have an idea of what things are going to be looking like, and that's inflationary. It's going to be, less productive, less output, and more tariffs, more costs to consumption. So inflation expectations, of course, higher, and consumer confidence lower.
Yeah, and how do you think this plays out? Because Trump's not willing to step back, is he?
No.
Tariffs take a long time to deal.
Yeah, I do think the one solution that does seem to provide some relief is a weakening US dollar, but that's also going to be very detrimental to US consumption. So I do think over time you're just going to be seeing the middle American be squeezed a lot. But consumer confidence being low is not something isolated to the US. I think people are very uncertain across a lot of the Western world and in Europe as well. So we might just, a recession I think is just so clearly written and rubber stamped on what we're seeing. So I think times are going to get tough.
And you say a weak dollar would help, but that means a strong euro, and that's going to hurt Europe even more. Germany's now been 6 quarters of contraction.
Yeah.
That's why I think personally the ECB need to cut more aggressively as well. Also, we're starting to see their disinflation's really kicking in, as we mentioned last week in Europe. So I think personally the ECB, the OAS is expecting ECB rates 64 basis points of cuts this year. I think it will be much deeper than that. GDP data came out the US as well this week. A lot of talk about the impact of the tariffs, but it came in negative, down 0.3%, a lot lower than expectations, although a broad range of expectations. And with that, core PCE, personal consumption expenditure inflation, surged, came in higher than expected, 3.5%, just more examples of stagflation.
Yeah, and one of the things that you've said on the show quite a few times is GDP. Obviously, it's a metric looking at the past. It's not a good forecaster necessarily, but it does flag up what we've seen over the previous period. And so US GDP on an annualized beta being negative, it sort of adds credence to this narrative that Trump has really been trying to cultivate somewhat, that the state of the US economy that he got when he arrived was terrible. And in fact, I think his quotes on Tuesday were, the stock market shows how bad a situation we inherited. And he said next quarter will also show the impact of Biden's presidency on the economy. So he's so keen to make sure that this image of the state of the economy that he inherited was terrible. But data like this and the annualized GDP showing that it's negative when we've had 6 months since election and only 4 months since his inauguration, it does indicate that the economy has not been firing on all cylinders, to say the least.
Yep. It was noticeable actually when the GDP data came out, equities sold off. Trump then said this is Biden's equity market. And then equities immediately rallied after that, which has been quite humiliating for him. On that, GDP from Canada also came out negative, down 0.2%, estimated to be flat. You can see the chart here. This is the US 2s 10s yield curve going back 2 to 3 years. You can see how it was inverted. You see the white line there, that's zero. It's steepening. It's gone sideways. But again, I just expect this to be more steepening. And that's quite a flight to safety trade as well. The 2-year yield will go down as the market prices cuts. Personally, I think the central bank will be forced to cut more aggressively. This isn't demand-driven inflation, but what that will do is will steepen the back of the curve. And we also have these concerns about US debt, so people will be nervous buying long-end bonds. So I think buying a curve steepener in 2s, 10s is a bit of a doozy trade. The euro dollar is bouncing again. It was unwound at the beginning of the week. People are unwinding the tariff trade. I mentioned that gold sold off. Well, now it's touched the key support of 112.63. You can see that was a previous peak. I particularly like horizontal trend lines. They work pretty well. And it's bounced off that and it's starting to rally again. And on that, the Southwest Airlines CEO has come out this week. He said, I don't care if you call it a recession or not. In this industry, that's a recession.
Yeah, and it's interesting, and it goes back to what you're saying about the ECB having to cut more. If we're talking about the US economy faltering and people not liking it, and the European economy is by no means in a good state whatsoever, and yet we're seeing this the euro dollar bouncing and staying at elevated levels. It's I think it's a particularly not worrying signal perhaps for the European economy, but it becomes a problem that they're going to have to deal with. As you say, they are going to have to cut rates very aggressively and be proactive with it. Otherwise, they're going to be facing even more structural issues in terms of exports, losing competitiveness.
And on the airlines, completely anecdotal, but I'm in Singapore in a couple of weeks' time. I was looking at airfares for a couple of weeks, and I suddenly got an email through yesterday about a sale and one of the main airlines, British Airways. I went online and the ticket's about 40% cheaper. And you don't get sales in booming economies.
No. And I do wonder when the business class cabins are going to be all converted to economy, because that seems to be the way that things are going. People aren't able to spend on the conspicuous consumption in the same ways.
We also had weak PMIs out of China, so the bond yields are retesting the lows. China's April manufacturing PMI slumped in contraction from 50.5 to 49. I guess it's what you'd expect. Companies were front-running the tariffs in the US, buying goods, and now that has quite literally ground to a halt. The chart here is the Chinese 2-year bond yield. And you can see it's back retesting the 1.6 lows. So they need more stimulus in China. Tariffs, it's hurting both sides, but both sides are reluctant to, or they want to save face, I think is the right term.
Yeah, there's a lot of bravado, isn't there? But I don't know, it's definitely not too rosy in China per se, but having the PMIs from what you would say was probably a slightly elevated level with the forward ordering. To be on a moving average in a decreasing pattern wouldn't necessarily be the biggest cause for concern, but I think the situation overall is not fantastic.
With that, the new orders part of the manufacturing PMI slumped to 44.7, the lowest reading since December 22. So you have an economy that's already struggling, more pressure, more breaks there. Global manufacturing as a whole. Here, this is data from Renaissance Macro Research and Macro Bond covering 36 largest countries, and only 31 of them have manufacturing in expansion. Over 2/3, it's in contraction. With that, we have more central banks cutting rates. In June, we have Eurozone, the market's pricing a full 25 basis point cut. In May, UK, the market's pricing 28, so looking for the chance of 50 there in the UK. May, we also have 25 price for Australia and 27 from the RBNZ. So the market's cutting rates into this economic data. And on to Germany, we did mention 6 consecutive quarters now of negative GDP, the longest recession since reunification. Tariffs can only hurt this, and a stronger euro can only hurt this as well.
Yeah, I think the last 2 points, global manufacturing and weak Europe, just supports this idea of global recession coming in. It's not isolated to one nation, and if people are especially going to be putting up barriers to trade significantly, then the whole world is going to suffer.
But while we're talking so negatively here, retail traders keep buying US equities. We'll see in a second that it's been a record month of purchasing. But if the S&P closes positive today, that will be a 9th day of gains, the longest winning streak since 2004. So when we had Liberation Day, equities sold off hard. The market seems to think the worst is behind us. And you can see the S&P here. It's rallying up towards the 200-day moving average. We've had a bit of a sell-off later in the afternoon, but it's still going to be an up day, longest streak from 2004.
Yeah, we saw things on. So obviously we're recording on Friday afternoon. We saw things on parity with where they were on April 2nd. So that the Liberation Day, the significant sell-off from tariffs. So it seems as though equities are supported, and to me it seems totally irrational because we just see negative. All of the indicators, all of the headlines seem to be pointing to weak fundamentals in the economy, and yet equities are just supported. It just seems so disjointed from everything else, doesn't it?
Absolutely. And if we look at even more so, if we look at the forward PEs on the next slide, S&P's current forward PE is 19.9 times. We look at previous recessions. In COVID, it got down to 13.4 times. NASDAQ bubble down to 12.8. 1990, it's 10.1. Financial crisis, 8.9. And you can see 6.5, 6.0. It's elevated at these levels.
Yeah, very inflated.
Yep. And I was discussing this with you as well, Toddy, beforehand. March 2008, Bear Stearns collapsed. You'd think equities would have gone down from then. Equities rallied another 15% all the way through August before they had their aggressive sell-off. And I remember that well because actually it's a time I lost as a trader. That was my biggest loss. Because just like now, we could see exactly what was happening, but the equity market refuses to believe it and just keeps buying. A good example of you can know what the fundamentals is doing, but actually the price action does not what you'd expect.
And the crowd can carry you out in this example, I think. And, probably the same in 2008.
The market can stay irrational longer than blah, blah, blah.
Yes, exactly.
Here's some data. There was some out from Goldman Sachs, but this is from JP Morgan, highlighting that record retail buying of equities this month, or I should say last month in April. And on that as well, funds were selling at the lows and they've not come back into the market. So what's known as their sort of institutional money, the professional money is out the market on the sidelines, and it's the retail that is buying into this market.
Holding everything up, isn't it? Yeah.
And on to gold, we mentioned that the tariff trade was being unwound. It looks like it's bouncing again on Friday afternoon. Gold peaked just over a week ago at 3,500. It sold off down to 3,200. It looks like there's a keen support there to buy. We mentioned at the last Macro Monday, we both think this market goes up, but you need to wait till it turns and starts trending higher again. It looks like the leverage longs have been shaken out, and it looks like there's a bid coming back into this market.
So here as well, it seems as though it's got this this range that it's established between this all-time high that it flirts with a bit and this $3,200 support. To my eye, that looks like quite a large range, and this becomes something that I think might be slightly difficult to trade because it's the momentum has gone from it, and it becomes hard to establish what the next move's going to be. How would you look at this, or would you just not be tempted to put money in there until it's sort of broken one way or the other?
Yeah, it's a really good point. I think because it's a wide range, what tends to happen is the market goes sideways in that range for a while and waits for the break. The stops are placed now below 3,200. The long entries above 3,500, and it can go sideways until it breaks those levels, and then you'll get an aggressive break either way. But I could see, actually, it's a great point. I could see it going sideways for some time.
Yeah.
To Brent.
Well, speaking about Brent, this was something that was in quite a sideways range for a good amount of time between that $80 mark and the $70 mark, and that has broken. Things are looking particularly weak. So we've moved, we're on the second trading day of May now, so we're on to the next set of futures. So the July futures are now the most pertinent ones, and we're nearer that $60 mark. We saw yesterday the June, the July futures nearer, 50 sub $60, $59. But things have been weakening. you do have managed money sort of being net sellers, etc. But I think one of the major worries that we're seeing at the moment on the crude side of things is supply and the potential oversupply. So we saw headlines we discussed last week, Kazakhstan openly admitting that they were going to be producing more than they, would naturally have been prior under the quota. Everyone knows that Kazakhstan cheats, but if we move on to the next slide, we also see that certain things we've had the OPEC meeting that was scheduled to be on the 5th of May. That's been advanced. It sounds as though they're now meeting on the 3rd of May to discuss this increase in supply that they're going to be doing. And what you've been seeing as a result is a lot of people don't just express their crude opinions based on Brent. They also look at other crude grades. So one of the interesting ones is Dubai. The Brent Dubai diff, they're two different sets of crude oil, and they're traded as pairs a lot of the time. So we've been seeing an aggressive set of buying in this Brent Dubai diff. But in the context of the previous slide with Brent coming off so much, what this really implies is the Middle Eastern crude standard has been weakening a lot. And this, I think, is because people just need to be selling because they're so worried that OPEC are going to flood the market. Their new announcement is going to be, we're going to be piling on, more supply. And in the context of the of the $60 per barrel Ural-Russian crude oil cap, that is now where regular Brent is. So I think a lot of people are worried that we're going to be seeing an inundation of crude product on the market and a really significant decreasing price effect on crude.
And it is Dubai. If OPEC are increasing or cutting supply, it's the Dubai that they're trading. So that's why we see that Brent Dubai move so much.
Yeah. So of course, OPEC also has a number. It's a number of countries that produce sort of slightly different grades of crude, but Dubai is probably the most pertinent one to the OPEC decision. So yeah, we've been seeing a huge amount of strength in this Brent Dubai diff, and I think a lot of the discussions we've had have been saying, well, it doesn't necessarily. If you were to remove the context of the OPEC announcement, you wouldn't think that this strengthens and that this goes up from here. But in the context, I think people are pretty, keen to remove any risk and sell their Dubai length, i.e. buy Brent Dubai and perhaps sell the Brent futures as well, or Brent swaps. So yeah, it's an interesting one. And similarly, this graph is taken from Onyx Markets. So if you want to be trading Brent Dubai and making any decisions based on the OPEC announcement coming up, please do. And we will hopefully have more clarity on what the exact announcement is going to be by Monday.
I think the market's also nervous because if you get an announcement over the weekend, it can gap higher or lower on the open and miss your stops.
Definitely. I think what has been noteworthy is the sort of Machiavellian timing of the OPEC announcements and the leaked headlines so far. Because what we have seen up to this point was either on big, US macro tariff headline news, those seem to be the days that OPEC would test the waters with announcements so that some of the perhaps bearish sentiment was absorbed in the market. And similarly, it's no surprise to me at all that they're making this announcement on the 3rd of May, being Saturday, whilst the market is closed, because I think they want people to be able to digest this and think, oh, maybe it's not actually going to be that bad. I think what I'm anticipating is OPEC announced that they're going to be really increasing the amount of crude supplied, and they're worried that that's going to decrease the price too much. So yeah, they're doing it on the Saturday so that hopefully people have a nice sunny weekend and are in a good mood and don't sell all of their length out.
It'll be exciting open on Monday.
Definitely.
Onto the UK yields. Just an interesting chart. The interest rate swap, the 2-year yields, that's breaking the previous lows. Again, horizontal trend lines are pretty powerful. You can see it's breaking the 372. The market's expecting more cuts now from the Bank of England, and that one's trending lower. So central bank OIS pricing for the next 12 months. Again, I think the central banks are going to have to cut more aggressively. Really, it's the next 2 weeks we're going to start to see, or late May, early June, we're going to start seeing problems in the US with lack of imports. I'm hearing more and more that it's be the middle and small businesses that are going to struggle. For instance, like bike shops, if they're running out of stock, stuff like that. Yeah, we'll start to see the impact coming in the data very quickly. Personally, I think the market will price in a full Fed cut in June, maybe even looking at a chance of 50 like we're seeing in other markets. We've mentioned already ECB, Bank of England, RBNZ and RBA have cuts, or full cuts priced in the coming weeks. Bank of Japan, they were unchanged this week and they've become less hawkish. They have inflation there. They've been looking to raise rates, but they're talking about uncertainty due to tariffs. And in fact, in the last hour, they've taken a kickback at the US, saying current discussions are unacceptable. So there's no tariff agreements coming in the near term with Japan. So what do we have next week? Actually, it's a pretty quiet week data-wise. Monday, US services PMI and services ISM. Tuesday, Eurozone PPI. Wednesday, the FOMC Fed Reserve meeting, nothing expected there. Friday, Canadian unemployment. So pretty quiet week on the data front, but it's going to be a big week, another big week on the headline front, I think.
Definitely. And, we're in a holiday period for most of Japan and China with Golden Week at the moment and Labor Day. And it's a European sort of start to the month. So I wouldn't be surprised if we see, particularly thin conditions going into the start of next week. But yeah, you can never be too sure what's just around the corner, especially with such a trigger-happy president. But.
So we will be doing daily updates as we do regularly now on our LinkedIn page, Onyx Institute, where you can also find out about our learning and development, which we're doing both webinars online and face-to-face around the world. So please do look there. Have a great week trading, and we'll see you on the next Macro Monday. Thank you very much.
Thank you.